Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. In today's episode, we're diving into some incredible developments in the mortgage and real estate industry that unfolded this week. We're talking about a trio of announcements that could be game changers for the market. They say good news comes in threes. I don't know if that's true or if it's from the same school of science as astrology, but it happened this week with mortgages. First, Ottawa announced a bombshell loosening of mortgage insurance rules. Second, inflation stunned economists by undershooting the 2% target. Third, the United States Federal Reserve threw a party for the markets with a jumbo rate cut. All of this went down in the short span of 75 hours. Here's a quick peek at how this trifecta of bullishness could awaken Canada's real estate market. Out of nowhere, the government decided that Canada's default insurance market needed stimulation. Starting December 15th, for those seeking insured mortgages, the government will allow a 50% increase in the maximum allowable home value from $1 million to $1.5 million. They will also allow 30-year amortizations for buyers of new builds and for all first-time buyers. The first measure corrects the fact that value limits on insured homes haven't kept up with the 76% surge in home values since the rule was instituted. The second measure creates a more liquid pool of buyers for new homes, incentivizing the construction Canada desperately needs. The third change levels the playing field for first-time buyers who don't have down payment assistance from their families. All of these initiatives help put young voters into homes sooner. But far be it from me to be cynical and assume that desperately clinging to power by wooing disenfranchised home buyers was in the government's playbook. I'm sure it was just a fluke that every housing policymaker I've ever spoken to in the years leading up to this move was staunchly against such measures for fear of creating further imbalance in the housing market. In any case, while one can debate the pros and cons of these policies, what's undeniable is that the mortgage and real estate industry just hit the jackpot. Lenders relying on insured securitization to fund prime mortgages are especially grinning, including publicly traded companies First National Financial and MCAN Financial. For months on end, the Bank of Canada has predicted that inflation would reach the 2% target in late 2025. But on Tuesday, inflation unexpectedly slowed to just 1.95%. That's more than 3 quarters ahead of schedule. Suddenly, the Bank of Canada has more leeway to cut rates without fear of reinvigorating inflation. And that's precisely what it'll do, with markets pricing in 200 basis points of rate cuts within 24 months, according to forward rate data from CanDeal DNA. Such a drop would drastically slash payments, increasing the appeal of home buying relative to renting. It would also trim borrowers' debt-to-income ratios, making mortgage qualifying significantly easier. The resulting additional demand could mop up much of the inventory that's piled up since 2022. 9 out of 10 economists expected the U.S. Federal Reserve to trim rates just 25 basis points on Wednesday. Despite the U.S. economy being in good shape, the Fed's words, the central bank instead decided on a supersized 50 basis points cut. Clearly, U.S. policymakers worry the economy is more fragile than advertised. A 50 basis pointer theoretically lets the Bank of Canada cut more as well, since it doesn't have to worry about a widening U.S.-Canada rate differential tanking our currency. And both the Bank of Canada and the Fed will expedite rate cuts if they see unemployment accelerate, which I'd put at a better than even chance. Many of us in the housing analysis business thought falling rates would perk up real estate more than they have. But most wannabe borrowers either can't pass the government's stress test or can't rustle up the minimum down payment. Moreover, history shows that the early days of rate cuts often fail to spark home buying. It takes time for incomes to catch up, affordability to return, immigration to add demand, rising unemployment to simmer down, and so on. This week's trio of bullish mortgage events should give real estate a shot in the arm by the first quarter or before. As with all policy loosening, though, some buyers will try to jump the gun and beat the crowd, like racing to the buffet before it opens. Adding to demand is slowly improving affordability. Real estate has been correcting sideways for 2 years. Lower prices and rising incomes have been quietly working magic behind the scenes. For instance, the typical home is now just 4.2 times gross income for dual-income households earning average weekly wages. That's down from a nosebleed 5.9 in February 2022. The gifts that the real estate market got this week will keep on giving throughout 2025. The federal government's two big changes to mortgage rules this week grabbed headlines. But just how seismic will those adjustments prove in helping Canadians buy a home? Finance Minister Chrystia Freeland's announcement of a hike in the insured mortgage cap to $1.5 million and an expansion of 30-year amortization eligibility sparked a wave of reaction in the mortgage industry, ranging from optimism to scorn. Speaking with Canadian mortgage professional, high-profile Toronto broker Elin Weintraub, co-founder of Mortgage Outlet, described the measures as a nice little step in improving buyer prospects, but suggested they may not move the needle significantly for many buyers. The decision to increase the insured mortgage cap means buyers purchasing a home up to a limit of $1.5 million can now use a down payment of under 20% and avail of mortgage insurance. That's positive for some buyers, but fails to address a significant problem for most, namely, the eye-watering personal income required to secure a mortgage at those prices. Weintraub offered the example of a 10% down payment on a $1.5 million property, a scenario which would leave a borrower needing a $1.35 million mortgage. Generally speaking, you can borrow 4.5 to 5 times your income today, he said. So that means your household income on that mortgage would need to be about $275,000. What proportion of people are actually making $275,000 a year? So I don't necessarily think that this is exciting. Specific examples of hopeful buyers who may benefit from the adjustment, according to Weintraub, could be professionals whose salary skyrockets after reaching their designation, such as physicians or accountants, or a married couple where both individuals earn six-figure salaries. But on the surface, again, it's a very small segment of buyers if you think of the math, he said. The decision to extend 30-year amortizations to more buyers is a move that's likely to have a more material impact on the market, Weintraub said. The government's introduction of 3-decade amortizations earlier this summer initially only applied to first-time home buyers purchasing a new-build property. But adjustments announced this week expanded that option to all first-time buyers and all purchasers of newly built homes. Weintraub said that move is likely to increase the amount that many Canadians are able to borrow relative to their income, a welcome development for those who may have previously been on the margins, but could now potentially qualify for a starter condo in a softening Toronto market. That could provide a glimmer of optimism in that market's darkening outlook, he said. It might build some stability because all of a sudden now you have buyers. Number one, they've got low rates, first-time buyers, lower rates. And number two, better for qualification. And number three, now their monthly payment is going to be lower because before, the monthly payment might have been $3,000, and now it might only be $2,700, $2,600, depending on the scenario. So people are finding it more palatable to buy. For single Canadians earning up to $70,000 or so a year and hoping to buy in an urban center, purchasing prospects will remain incredibly difficult despite the rule changes, Weintraub said. But again, if you're a married couple or established nurse or police officer, whatever it is, and you're making $100,000, at least now you can get into the market, he suggested. It's definitely not going to help everyone, but it'll definitely help some people incrementally. This week's changes alone are unlikely to bring about a surge in home buying activity in Toronto, but they seem to be contributing to a general feeling that the market is moving in the right direction. The Bank of Canada has cut its benchmark rate 3 times in recent months, with further reductions seemingly on the way, and a fall in fixed rates since April is also boosting confidence among homeowners and buyers alike. For Weintraub, an improving outlook is more driven by lower rates and anticipation of even lower rates. That's the big factor. And then this is a nice little sort of push, a tailwind to push us a little bit farther along, he said. It's not going to change the market for the rest of the year, but it will give us a little bit of a push. Canadian builders are applauding Ottawa's move to raise the dollar limit for government-backed mortgage default insurance by 50%, the first cap adjustment since 2012 as property values rise across the country. Rising detached home and condo prices in Toronto have led the federal government to raise the threshold for mortgage default insurance. This adjustment is seen as a positive step by builders who have been grappling with escalating costs and affordability challenges for potential buyers. The move to increase the mortgage insurance cap is expected to provide better access to loans, making it easier for Canadians to enter the housing market. This is particularly significant in high-demand areas like Toronto, where home prices have soared, putting pressure on both buyers and builders. The cap adjustment is a response to the growing gap between home prices and the previous mortgage insurance limit. By raising the threshold, the government aims to bridge this gap, allowing more buyers to qualify for mortgage insurance and thus secure financing for their homes. Builders have long advocated for such changes, arguing that the outdated cap was a barrier to home ownership for many Canadians. The increase in the limit is seen as a way to stimulate the housing market by enabling more transactions and supporting new construction projects. The Canadian Home Builders Association has expressed strong support for the government's decision, highlighting that it will help address the supply-demand imbalance in the housing market. By making mortgage insurance more accessible, the new cap could lead to an uptick in building activity, which is essential for meeting the housing needs of a growing population. In addition to the cap increase, the government has also introduced measures to extend 30-year amortizations to more buyers, a move that builders believe will further enhance affordability. This combination of policy changes is expected to create a more favorable environment for both buyers and builders. Overall, the reaction from the building community has been overwhelmingly positive. Many see these changes as a long overdue adjustment that will help keep the housing market dynamic and responsive to the needs of Canadians. As we navigate these new rules, it's crucial to keep an eye on how they impact both the short-term and long-term dynamics of the real estate market. Builders and buyers alike will need to adapt to these changes, but the general consensus is that this move by Ottawa is a step in the right direction. The Trudeau government, down about 20 points in the polls, has announced new mortgage rules for Canadians in a bid to address the country's long-standing housing affordability crisis. Responsibility for housing policy in the country is shared between local, provincial, and federal governments. But voters are typically more interested in results than who does what. Trudeau is hoping that two changes within federal jurisdiction will help deliver those results. The new policies, which take effect on December 15th, include raising the price cap for insured mortgages to $1.5 million from $1 million, the first increase since 2012. The higher cap allows a greater number of purchasers to buy a house with a down payment below the 20% threshold if they obtain mortgage insurance. The Liberals will also permit 30-year mortgages for first-time buyers of any type of home or buyers of new builds. The move is an expansion of a recent policy change. Earlier this summer, the government opened 30-year mortgages for new buyers who purchased new builds, raising the amortization period from 25 years. In August, the average sale price of a home in Canada was $649,096. Labor shortages and high interest rates have hampered home building efforts and kept the country well behind the rate of building the Parliament Budget Officer estimates is necessary to lower costs and make housing affordable. The Liberals, however, hope the latest policy changes and Bank of Canada rate cuts will drive construction efforts, lower prices, and get more Canadians into home ownership. The reforms come as the Liberals prepare for an election scheduled for October 2025. That might come earlier, and struggle to improve their standing in the polls. That wraps up our episode for today. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hemoen. Stay informed, stay ahead, and we'll catch you next time.